Good morning. So today's plan is we will finish the chapter's lecture. We'll talk about the disclosure, presentation, and interpretation. And then we will go over some real statement of cash flows. I posted a couple from Empire Incorporated Limited, I think Empire Company Limited, and Tesla. They are very different companies at a different stage of the life cycle, so it's interesting. And it also ties into our assignments. The last part of the assignments, we're going to talk a little bit about how to read the statement of cash flows. And so the next class, we'll go over another example, because statement of cash flow is that topic because it's challenging. So it gets shoved from one course to the other, right? So you kind of probably heard about it from 2241, right? But it's always kind of like not really get a good coverage. So we're going to do this. And then next week, we have one more class left. We may talk a couple of things from chapter 23, just kind of FYI, sort of introducing some topics. And then we'll talk about the final exam. So that's the plan for the rest of the course. So towards the end, in that comprehensive complex example, we talked about the disclosure, right? There are certain things that are not shown in the statement of cash flow per se, and there are certain additional information. If it's not in the body of the statement, then you have to show it as notes or additional schedule. Okay, the one that we experienced in both direct and indirect format is a non-cash investing and financing transactions, right? So our example is land equipment. Some PPE was purchased in exchange for a note, with company issued a note for the purchase. So anytime you have that kind of arrangement, you don't have just like a no cash at all. So if you in the quiz, you have a situation that if you paid a down payment, that's cash flow, got to be reported. But then you also take on a mortgage for the remainders, the balance, then that part would be the non-cash financing investing transactions. Now, obviously, we talk about the statement of cash flow focus, not just narrowly on cash, but the cash and cash equivalent. So companies should explain what do you mean by cash equivalent, right? So there's a policy on what makes up cash and cash equivalent. This is just the bottom part of the statement of cash flow that reconcile with the cash or cash equivalent reported on the balance sheet. So that's fine. But we also had the two additional disclosure under the indirect method, right? So that's the requirement of IFRS. That's income tax paid and the interest and dividends paid and received should be shown somewhere. Okay, so it doesn't matter where it is reported as long as it is reported, right? So in the direct method, the tax and dividends paid is always there. Tax and interest paid is in the operating activity section already. So you don't need to disclose it anymore. But when you use the indirect method, those are not there. You know, pure indirect method, cash paid for interest is not there, and the income tax paid is not there. Then you have to disclose. The last thing is if there's any cash equivalent is restricted, means that's earmarked for specific purpose, not available to meet the general obligations, you should disclose that as well, right? Now, about the presentation, as we said, both ASPE and IFRS encourage company use the direct method, but not required, right? And so they also have this requirement that you should reconcile cash from operating activities with the net income. And both ASPE and IFRS would kind of accept that cash from operating activities, that if you use the indirect method, start with net income, end with statement of cash flows, that's sufficient reconciliation, that's acceptable. So that's part of the reason why most companies use the indirect method, because they meet all their reporting requirements by doing that. If they use a direct method, they have to reconcile in addition to that. Now, some IFRS companies start with the income before tax or income before tax interest. And the reason they do that is, remember, if you use the indirect method, pure indirect method, interest paid, tax paid, usually it's not there. So you have to disclose it. But some company find a way to combine it all. So they use kind of like an indirect method, but it's kind of modified because they started the income before tax or income before tax and the interest, and then they reconcile. So after what they have will be cash from like corresponds to income before tax and interest. So what's missing is interest paid and income tax paid. And then you include those two, you have cash from operating activity. So that will meet two requirements. First, we reconcile income with the cash from operating activity. Second, the disclosure requirements, interest paid and tax paid, right? So when you read a real balance sheet, sometimes real statement of income, cash flow, sometimes you see that. Both standards require reporting of gross inflows and outflows for investing and the financing activities, right? There is no options of the format, and you can't net. That's what it means, right? There are some other things such as foreign currency, business combination, that's advanced topics, so we're not going to worry. So interpreting statement of cash flow, read statement of cash flow. Okay. Now, statement of cash flow reports the inflows and the outflows in 3 different activity sections. So first is the big picture. When you read statement of cash flow, first is the big picture that like when you say where did the cash come from, where was it used for? Usually you look at the big picture from operating activity most times, and it's good, and mostly used for most successful, mature, and maybe growing company will be most cash from operating activity, and most uses investing activity, and the financing just depends, right? If it's growth outpace your cash generated, you raise more cash. But if you have more cash generated, then you need to invest. You pay dividends, pay back loans, and things like that. So that's the first one. Now, sometimes I think when you read a statement, that you have to remember what is the purpose of the statement, right? So ICP student would say, oh, they generate most cash from revenue. Of course, but that is not really like, of course, what else? Like you're in a business, right? You generate revenue, but you have to pay expenses to earn the revenue. So it doesn't mean that's so generate most cash from a revenue, like you cannot generate cash from expenses given, doesn't mean you generate most of the cash from operating activity, right? So that's very different. Like the second, that whether you generate a lot of cash from operating activity, that's relevant information that you're telling people something. when you say generate most cash from sales, you are not really telling people a whole lot. And then after that, you look at each section in greater detail. Your accounting information is always read and interpreted in the context of what you know, what kind of business it is, what kind of strategy they have, what stage they are at. You know, that's always make the information like much more meaningful. You know, sometimes like a thorough analysis of cash flow includes sensitivity analysis of the effect of change in assumptions. So ultimately, when you read the statement of cash flow, you want to know whether the company will have a healthy cash flow going forward, right? So if things change, then you know what happened in the future will change. The sensitivity analysis allowed you to assess what if the conditions, assumptions changes, how that will affect cash flow. So that's zero in on like operating activities section. Now, one thing is if you notice that operating cash flow typically is much greater than net income. Okay, not always, not 100%, but typically vast majority situations of CFO is greater than net income. Okay, so if we think about how CFO is determined, especially if you think about indirect method, because that can reconcile this, right? Remember, there are 3 groups of adjustments we make to net income to get the cash from operating activity. Okay, change in working capital, right? Change in working capital. You know, if a company is growing, the inventory, accounts receivable, prepaid expense probably will all increase. But accounts payable, accrued liability probably will increase as well. And this one, remember, increase in assets is subtracted, increase in liability is added. So these usually cancel each other out to a significant degree. So usually changing working capital will not consistently affect like, you know, the difference between net income and CFO in one direction only, right? Because you may increase the current assets a bit more this year, but you know, eventually these assets liability should be consistent with the business activity, right? So that we will say doesn't guarantee one way or the other. The second group of adjustment is the gain and losses from sale of PPE, for instance, from retirement of debt, so on and so forth, because these are not operating cash flows, right? These are like a really underlying activities, investing and financing. So the cash flow will go to those sections. And again, like the company will not consistently have gain, will not consistently have loss. So like they offset each other too. Then that leaves only one group left, that is the non-cash expense, such as depreciation, amortization, impairment loss. All of this are non-cash expense, result them to be add back. So the adjustment is always positive. Secondly, depreciation, amortization often are substantial expenses. So basically, lots of times, if not all the times, we from net income, we adjust for some other changes. Usually their net effect are small, but then we add a large number back to that. That's depreciation and amortization. That's always addition. You always add, and usually they're quite large, right? So that's why CFO should be a lot bigger than net income. The direct method provide more details about the sources and uses. The indirect method explains the difference between accrue and net income on the cash basis. So like keep in mind when you see the adjustment in from accrue to cash, that's the change. That's the change in those accounts. I often see people saying, oh, you know, they have no accounts receivable, it's almost zero. That doesn't mean if there's a small number of accounts receivable on cash flow statement, it's not, they have very little accounts receivable. It means accounts receivable changes the level. Okay, so that's it. Users' financial statement need to analyze the reasons for operating cash flows. Objective is to assess if cash flow level are sustainable and likely to be repeated in the future, or whether they result from payment or deferrals in one-time events. So, you know, we say earnings is meaningful, but the earnings subject to accrue rules. So there are flexibilities, discretions, and cash flow is not manipulatable, but that's not really entirely true. Company can stop buying inventories towards the end of the year to preserve cash, and right. And if the company does that, you will be able to see the inventory will reduce significantly, you know, and it will see the impact on statement cash flow. Kind of raise some flags. The company may stop paying accounts payable because they are short of cash. And then, you know, you will see that on the balance sheet, but you will also see here how that affects cash flow, right? So anything that's recurring, sustainable, that's good, because that's, you can count on that to generate the cash consistently. From investing activities, that's two types of investment. One is investment in financial investment, and the other investment is in PPEs, in infrastructures, right? So that's, we need to differentiate that one. Now, as we said, if a company is growing, there will be a lot of investment in PPEs. If a company is stable, mature, probably they still need to invest just to replace the ones that's worn out, right? If companies stop investing altogether, then, you know, they're not keep up the maintenance of their, not upgrading, not taking care of their infrastructure. So you can assess that by compare the investment with depreciation to assess if the company keeping up with that. You know, you need to upgrade, replace, and all that. Usually investing activities, especially the investment in PPEs, it's not great source for cash, not great source of cash. And so if company may have other investment, like they may hold real estate, they may hold some other investment as well, but you know, if they sell it, they have nothing to sell in the future, right? So usually investment section is not a main source of cash. Financing activity, as I explained, I think early on, the way it works, this it's more like a service department, right? Operating, that's the main core business. Investing is also important, and it's especially important to the future of the business, you know, if you keep up with its facilities, infrastructures. Financing is more like a service. So if you need cash, I will go to raise cash. This is whether this one should have inflow, outflow. It's the answer to what happened in the other two sections, right? If a company generates a lot of cash and enough to cover all the investment, then you will have negative financing cash flow. Negative financing cash flow is not a bad thing at all, okay? But if company is growing so fast that the cash generated from operating activity is not enough, then you go to raise a fund by issuing shares, issuing debts. And in short term, that you should do, but you can't keep doing that all the time, because the debt eventually needs to be paid back, plus interest. And if you keep issuing shares, share will devalue unless you earn some, right? So like you have to issue more shares to get the same amount of money, keep going. So the objective to of analyzing this part is to assess, borrowing ability going forward, because if you keep borrowing, you reduce your borrowing ability and you have heavy burden to serve the debt, right? But if you pay off lots of debt, you have borrowing capacity. Financing, capital structure, whether you are increasing debt, decreasing equity, or decreasing debt, increasing equity, that affect your risk, financial risk of the company, that, right? The last thing, we're not a same analysis course, so we're not going to talk about a lot of ratio, but do indulge me with one ratio called the free cash flow. Okay, so free cash flow is easy to compute. It's basically a net operating cash flow minus the capital expenditure. So the capital expenditure is different from cash from investing activity. This will be just the amount spent to purchase new PPE. Okay, so this is net cash flow minus capital expenditure to sustain current level of operation. Okay, not just whatever you need to sustain the current level of operation. So the idea of free cash flow is the cash you generate from operating activity after taking care of your business, spend to maintain your current level business activity. What's left, that's free cash, discretionary cash. Means you can use it for whatever, have fun, do the things you want to do, such as expand, buying new business, paying dividends, paying off debt, right? So this free cash flow kind of basically is very important of what company is able to do, have resources to do. Okay, so you can take advantage of new opportunities or cope well with the poor economic times without jeopardizing current operations. So you have extra resources. If there's a good opportunity to invest, that you are in the position to do that without external financing. And if things go bad, you're okay. You have something stashed there. So that's it. So that's like I finished pretty much everything that we need to know. Now, just because I illustrated once, I know that's not enough. So I have an additional example, which is very similar to our homework assignment, right? So I will do it on Thursday, just because I have other things prepared for today. But you can go ahead if you want to practice with it, but we will discuss it in the class. I may start it if I have time. But let's look at some real statement cash flow. So first of all, let's look at one that's, let me see where it is first. It's not it. Oh, this is the one. So let's share that one. Okay, I apologize for this is being a little bit small, but it's like I can zoom it out a little bit, then you only see a section at a time. It is on the bright space. So this is Empire Company Limited. How do I get rid of this thing? Anyway, we'll just focus on this half of it. Which is basically Sobeys' parent company. Like I think Sobeys actually is 99% more, 90% plus anyway. So these are fairly old, it's like 17, 18, because it didn't change that much. So it doesn't matter that much, right? So you see just overall, you see the three big cash flows from operating. We have a 2018 is a 979, I think that's billion It's a billion or million? Oh, it's a million. Not quite a billion, $979.9 million generated from operating activity. There is net outflow for investing activity, but minimal, okay, minimal. And so quite a lot of cash was used for financing activity. And I think 2017 is very similar, except a lot more cash was used in financing activity, right? So that's main source. If you have the main source will be operating activity. Main use will be financing activity, right? Investing activity use, the net investment is small. Okay, now that we have a close look, you see both 2017 and 2018, Empire is profitable, have a net profit. However, this net profit is less than $200 million. It's a lot less than their cash generated from operating activity because they have a huge amount of depreciation. They have huge amount of depreciation and amortization here as well, depreciation and amortization. Now they back out, they back out the interest expense and the finance expense here because I believe they have the interest paid and the income tax paid down here. See, you have, they back out the income tax expense here to replace that with the income tax paid. And they back out finance cost here. And let me see, there should be somewhere. Oh, I think their interest probably is in interest received is in financing in investing activity, and interest paid is in financing activity. Okay, so Empire reports under IFRS, and the IFRS you have a choice not to treat interest received as operating activity. That's what they did, right? So they did a kind of a by backing out the tax expense here and put a tax paid here, they meet the disclosure requirement as well. Okay, so the biggest difference between net income and cash from operating activity is depreciation and amortization, and also the interest income tax is subtracted here. Oh no, interest expense is subtracted here, but interest here is in financing activity, right? So that's also. Let's see. Equity in earnings of other entities is here as well. Why is that? These will be the equity in earnings of other entity. Remember, when we have equity investment, when the company report earnings, we report earning as the investor, but that's not cash. So this will be the dividends, earnings distributed by equity investment company, right? So that's what it is. So these will be increase, decrease of non-cash working capitals. You see the net change is not that big, right? The amount is small. This year, some increase, some decrease, they offset each other. Okay, so that's what the operating activity, right? They generate most of cash and they'll have positive earnings, but cash flow is much more than the earnings because depreciation and amortization and impairment of those non-cash expense and other things. So that's that. For investing activity, that's we did say the net investment is minimal. However, it doesn't mean company did not invest. Actually, company spend quite a bit 239.8 million in 2018 on property, equipment, and investment purchase. Okay, that's important because they depreciate a lot, right? They depreciate a lot, so they did purchase the new equipment. This year, the purchase is less than the depreciation, but the previous year, the purchase is more than depreciation. Okay, so they are taking care of their capacity. That's good. However, they also generated cash from asset disposal. So they sold some assets. Now, I do not have more information here. If we are talking about the full analysis of the company, I will look into what the kind of asset, why they sold the assets. Are they doing restructuring, you know, or are they kind of closing some stores? What are these assets? Are they kind of a lot of companies have finance services, and then there was very popular, most of the company decided to have, instead of using credit cards, to have their store credit cards, but then later on they kind of retreated from that. So a lot of companies sold their finance subdivision. I don't know if it's Sobeys case, but I will look into that, right? So yes, so even though the net investment in cash flow is small, but they did spend substantial amount on PPEs, which is good. However, because they also sold some assets, that's why the net cash flow is small. Okay, so given they had a lot of cash generated from operating activity and the net investment is small, so they have a lot of cash to play with, right? So what they did is they pay off long-term debt a lot, both years. They paid a very healthy dividend both years. Dividends usually stable. Company usually do not change their dividend policy, like, you know, in the short term. So dividend amount usually doesn't change a lot. Another one has a net repayment of credit facility. I honestly don't know what it is. I suspect it has something to do with they have a finance service part for the credit facility. And then, yeah, that's about it. They're paying off lots of debt. They issue the payment of credit facility. I cannot explain it better without looking further. And then the interest payment is here. And then they also pay lots of dividends. Okay, so as a result of that, so in 2017, they pay off more debt. So their net change of cash, there's small net decrease in cash balance, which is fine. 2018, however, they kept a lot of cash. That's a lot of cash. So it increased the cash on hand, almost tripled it, right? Almost triple. Yeah, it is tripled it. So I suspect that they may have some pending spending, right? You shouldn't keep that much cash if you don't have a good reason. And that's what I suspect. Anyway, so that's a typical statement of cash flow of a successful, mature company. This is the most recent statement of cash flow from Tesla. Anyways, the Tesla did not have a nicely packaged annual report. So the statement of cash flow is downloaded from SEC website, and they just like from their 10K report. So they have all the information there, except it's very busy report and the statement have lots of information. So I tied it up somewhat. It's still quite a bit, but that's focus on. I like to help us to focus. I actually put these red. So for we know what the Tesla is. So they turned a profit 2020. That's the first year it is profitable. So their cash generated from operating activity is substantial and increasing, right? However, their investment is also substantial and increasing. Oh, well, yeah, substantial, increasing in current years, but the 2019 is not as high as 2017. And so the shortfall is made up by financing activity, as we said, right? But what's interesting here is that there is way much more cash than they need, right? See, well, actually, in 2020, the first 2 years, well, only 2018, they didn't have enough cash to cover the investing activity, but 2019, they did not invest much, which is fine. 2020, they earned enough cash to finance their investing activity, but they still went ahead and raised a lot of cash. This is one, if you know that what's going on, will help, right? So what happened is that Tesla's share increased a lot. And there's like, if you pay attention to that, many people think, I think I see one report to say, if Tesla continues to produce electrical cars at the current level, it would take 1,000 years to make enough money to justify the valuation, because the share price went from like a couple hundred to 800, 900 at highest, right? So a lot of people think it's overpriced. And Elon Musk is a very smart person. He goes, that's fine, I will just issue more shares, so I have all this cash here, you know, that will carry me a long time, you know, like, so that's why they take advantage of the high price of the shares. So raise money, you know, he's going to need it. He has so many ideas, needs financing, right? So even though, so that's the big picture. That's a big picture. Now let's look at the operating activity again. So even though first 2 years of these 3-year periods, the company has lost, it still has a positive cash flow from operating activity. Again, depreciation and this stock-based compensation, that's also non-cash expense. Amortization, all that, it resolved a positive adjustment. And the cash from operating activity is significantly higher than net income. So because the company grows fast, so its working capital can also increase quite a bit. But as I said, the main difference is those non-cash. And not surprisingly, the most investing cash flow is for purchase of properties, equipment. Company is growing. I think they keep building like a battery factory, more manufacturing. I have like these power stations and all that, right? And for financing activity, let's focus on 2020, most of the cash are from issuing common stock in public offerings, okay? They also have some convertible and other debt, because convertible debt has the advantage is like you can lower the rate or issue for more money, because this convertible potential we talked about. Given Tesla's share is price is so high and it's growing very fast, that conversion rights will be very valuable, right? It will be very valuable. So we talked about it earlier. They paid out all of debt, of course, and some other things. The biggest is issuing shares and issue debt. Even issuing debt, it takes advantage of the share situation and reduce debt as well. So overall, the company's financing structure will be less debt, more equity, right? So that's Tesla is in very good situation right now. Look at the cash it has. Okay, it has 3 times as much cash in 2020 than 2019. So that's about Tesla. And I have, yes, one back 10 years ago, it's been a different situation. Okay, this is Tesla as well, but it's 2019, 10, 21, 10 years early. So that's the early stage. So companies not making money, so they have lost all years. Not only that, from operating activity, they don't generate positive cash. They're not selling a lot of vehicles at that time, right? So when this will be early stage of a company in the life cycle, so the situation will be different. So even though no cash from operating activity, they still have to invest. So financing activity provide the cash they need to sustain the operation, to continue to invest in the company, right? So it carries you longer, but eventually in Tesla's case, the share price did go up. So you don't have to pay dividend to make shareholders happy. Share price goes up is good, right? So you don't have to worry about that. And so you will see 10 years later, Tesla is still issuing a lot of shares. That's okay. The debt, you know, as we said, eventually you have to pay back, right? But at the early stage, this will be at the typical statement of cash flow. Okay. Investing activities require cash. Operating activity either don't generate enough cash or needs cash to tide it over, like here, right? So financing activity is what you do to get the cash. So some additional information. Okay, so that's about. I don't have it write it down, but let me just sum it up because you do need to answer the question about how to read a statement. So when you answer the question, what is the main source of cash, main use of cash, focusing on the 3 category operating activity first, right? And then you can go into a little bit of detail. So for instance, with the main use of cash is investing activity. And you should supplement that with, like, you know, what investment the company made, because investment in financial securities versus investment in capital assets are different, have different implications. So you do need to say that, right? And then other questions. So yeah, as we said, that. From look at the forest first and then focusing on interesting trees. And you do not need to comment on every single item in there. You just focus on the sections and then the big numbers. Okay, any questions about that? Okay. We still have a class, so if you have a question class about that, the assignment, that's fine. So we still have some time left. So let's start on this additional example. Let's start on the additional example. Okay. I posted on Brightspace. And so I also have it here. Let me see. Yeah, let's look at that one. Okay, so also copied it into a worksheet, Excel spreadsheet. We talk about the 4-step approach to prepare statement of cash flow, but we always start, before we start 4-step, we always look at the changes in the balance sheet and to analyze each changes, what caused the changes. Because remember, we said the statement of cash flow and the statement of financial position are so closely related. Changing cash equals changing the rest of the balance sheet. So if you analyze these changes systematically and make sure when you prepare statement of cash flow, you included all these in that, you will not miss anything. You will not miss anything. You will explain all the changes, because it's quite often after you prepare the statement cash flow, probably you are 85, 90, 95% right, but you missed something. You missed certain items and your cash do not match the cash on the balance sheet. And so my experience is you probably spend like say half an hour to prepare it. It could spend 2 hours trying to figure out what's missed. So it's always good to approach it systematically. Okay, always that's mine. So so what do we have? We have these 2 balance sheet. That's minimum. Remember, 2 balance sheet, and we have income statement, and also some additional information. That's the required information. So what we will do is we will just go over this. This is before the step 1 of the 4 step, but this helps. It set you up in a good position. So we will look at each one of this and then just to analyze what's some of this straightforward, some have more than 1 transactions, result that changes, and we can parse it out and separate it out, and then so make it ready to use. So first one, this is the change in cash. In the end, this is where we want to end, so we don't need to talk about this. Accounts receivable, so that's say we know this is straightforward. This is operating, right? This is the difference between sales revenue and the cash collect from customers. Prepaid insurance, that's also operating, right? Like it would be difference between insurance expense and insurance premium paid. We need insurance expense in the income statement, and we need insurance premium paid in the statement of cash flow. So this is operating. This will be the change in non-cash working capital here. Inventory, it's part of the difference between cost of goods sold and cash paid to suppliers for inventory purchase. So this is operating, change in working capital, right? Supplies, same. Okay, so put a bit more space here. So now we have a first item. Okay, this is, there are many items that is complex. If you look at the Soci example, there's many. So for us, we introduced a gain or loss from sales of equipment. So we introduced that. I think that's as a complex one, but we have one more. This will be it. I'm not like such as bad debt, such as deferred tax, you know, pension. We do not talk too much about that. It's not that hard, but it just we have limited time. So fair value through net income investment. This is kind of a many things, many issues about this. First is this is the investment. However, some company treat it as operating. This is, and in the textbook they did that as well. This is the reason fair value through net income investment can be justified as operating cash flow, right? fair value through net income investment usually are trading type of investment. So you manage it actively. The idea is you want to earn a good return. By managing it actively, you try to time, you buy and sell to maximize your return. So the basic objective of this investment is buy and sell to profit. And it's similar as you buy and sell inventory for profit, right? So that's the reason fair value through net income investment is considered operating cash flow. Okay, so that's first something, it's a kind of a not readily intuitive, right? It's kind of like there's some inconsistency here because it's investment. You wouldn't probably want to call it investing cash flows, but for the reason I just said, you actively manage that to buy and sell at the right time to maximize your return. It's much more similar to you buy and sell inventory to earn a profit, right? So secondly, for fair value net income investment, you have like a fair value gains or losses due to the change in fair value, right? So that will be the unrealized gain or loss. However, unrealized gain or loss is not cash gain or loss. So that will require adjustment because that unrealized gain or loss will be in the income statement, but there's no cash. Right, so that's that. And also in the income statement, you have realized gain or loss. But the realized gain or loss is different from cash proceeds, right? Because the realized gain or loss is the difference between the proceeds and the carrying amount. So because all of that, we must separate them all. And let's see this one. So this is 18,000 increase. And I think there is additional information tell us about that. So we'll use that, parse it out. So that's 18,000 increase. And associated with that, there is a operating investment income of $90,000. Investment income of $90,000. The investment income includes 62,000 unrealized gain and the 28,000 realized gain. Okay, so that 18,000 that must include 62,000 unrealized gain, because that's you just make adjustment at the end of the accounting period from whatever the carrying amount to the fair value, right? So that would be increase. So that is the 80, and you have realized the gain. So that means that must mean some of the investment were sold. Some of the investment must have been sold. Okay. So let's get this straight here. Okay, so how much must have been sold? Now it's only increased 18 and unrealized gain is 62. So the difference between that, in order for the increase to be 18, not 62, that must mean 44. Yeah, 44,000 sold. And sold for how much? Because that's a cost. Now, given we have a 28,000 realized gain. So that must mean the amount sold is $28,000 more. So it's $72,000. We know that because we know there is a realized gain of 28,000. Does that make sense? Yeah, so that's kind of a, let's expand on it. I will use this part to show it exactly what happened, right? T account is great thing. I really like T account. T account lay everything out very visually. You don't have to remember like increase, decrease, right? So that's a fair value net income. So this is the account. What we know is that at the beginning, we have a balance of 400,000. And we know at the end, it's 418,000. Okay, so we know that. In between, there are several things three things happen. First of all, no, two things happen. You sold some and you realize the gain. Okay, so I don't need it. That's a lot more space than I needed. I'll just put it here. Okay, that me set it up. So that's my account, T account, and I will put a T in. So it's an asset, so it's on the right side. So this is the beginning balance. And I will put a little space to interpolate it. So this is the beginning balance. And this is the ending balance. And this will be the sales. We figured it should be 44,000. This is actually a plug. 62,000 is given. This is the unrealized gain. Unrealized gain, and this number is a plug because we know the rest. This has to be a plug. We also even know there is a sales. So cost of fair value, net income, investment sold. And we also know sold. We also know the proceeds must be 72,000 because we were told there is a realized gain of 28,000. Okay. So that explains the change in this account. So when we prepare the step 2 and 3 to lay out the income statement number and then make all the adjustment to the cash number. So we will have to subtract this gain of 62 because that's non-cash gain. We also have to subtract the 28,000 because 28,000 is the gain but not cash flow. And we will replace that 28,000 with 72,000 because 72,000 is the cash received from sales of fair value net income investment. That's the only cash flow. of the year related to that item. Make sense? Yeah, okay. Land, there's a node, so let's go down to the node. The node number is a little bit off, but anyways, here's the node. During the year, Como obtained land with a fair value of 100 in exchange for its, is there anything more? Share, for its common shares, okay? So that's what happened. Okay, so we'll go back to look at that. So 100,000 purchased with the shares. So this will be non-cash financing investing activity. However, if you purchased 100,000, there should be 100,000 increase, right? But there's only 40,000 increase. So that means some must be sold. So that must be, land must be sold. Let me see, is there any investment equal? Yes, look at the income statement. That tells us not only the sold, it tells us how much it's sold for. 13,000 more than the cost. So from here, we can say, to get a 40,000 balance at the end must be $60,000 worth of land sold for $73,000, right? Yeah, because there's a gain. So that tells us when we make adjustment, we have to remove the gain from this operating section, but it includes 73. How should I say that? And for a gain of 13,000. So that adjustment we need to make is that 13,000 should be removed from operating activity part to convert income to cash flow, operating cash flow, and the 73 should be included in investing cash inflow. 100,000 is in the note because it's non-cash financing operating activity. Okay. Yeah.
Is the gain 13,000 or 73?
Gain is 13,000. Yeah. Sold for the 73 is the proceeds. Yeah. Okay. Buildings, there's an increase of 130,000. What happened there? Just note. There was no disposal of buildings during the year. So that means we must purchase, yeah, 13,000 purchase for cash. There's no information, it's not cash, right? The reason we're given that information, like if there's nothing said, you will have to assume this, right? Is if you have a situation, say you purchased some and you sold some, the net change is 130 because we're required to report cash flow growth. So we can't just say net purchase 130. We have to say how much was purchased and how much was sold, right? So that's why. Now that piece of information is just nice to confirm that this is net purchase. This is a total purchase. Okay. So because nothing was sold, so all the changes in accumulated depreciation must be the depreciation, right? Because if there is building sold, when the building is sold, the cumulative depreciation of the sold building will be removed. So the change in cumulative depreciation would be the combined results of two things, depreciation and the cumulative depreciation of the sold building removed. But this one is not case. So just a 40,000 depreciation on building. Okay, and so that's that. Next one is the equipment. There's a net decrease of 8,000. So we know there's some kind of sales. So let's say equipment with the original cost of 46,000 and the carrying amount of 14,000 was sold. What else? That's it. Okay, but we do have this information, loss on sale of equipment. Okay, so how much do you think the equipment was sold for?
On the Word document, the name
Yeah, what did it say?
was sold at a loss or near.
Okay, I do remember, I was trying to fit it in the column. Yeah, I removed something, but it didn't hurt us badly. Yeah, because that will help us to look for the loss in here, right? Okay, so, but here it is. That just direct us to this. So how much is this building sold for? Could we tell? Only 3,000, right? Because the carrying amount is 14,000 and there is 11,000 loss. So the building is only for 3,000. So that's put that part in. So that's did they say 44? 44? What's it 44? 46, sorry. 46 of building was sold for 3,000. Huh? Oh, yes, yes, where I'm talking about equipment now. Thanks. Equipment was sold for 3,000. Resulting a loss of 11,000. Okay, so the 11,000 should be added to the operating activity part because that was subtracted, right? And then this 3,000 goes into financing part. However, that doesn't explain the only 8,000 decrease. So that implies new equipment is purchased, right? Okay, so the purchase must be 38,000, right? So 38,000 of new equipment was purchased. So that is another investing cash flow. Okay. Any questions? Does it make sense? Take the one out of the screen. Yeah, here. Okay. One more item, we'll call it a day. So now the cumulative depreciation for the equipment is 30,000. Now we can't assume all that is depreciation expense because we have equipment sold and the sold equipment was depreciated, so we have to that. So we know what the depreciation is because we were told the carrying value of solar equipment is 14,000 and the cost is 46,000. So that implies the cumulative depreciation is 32,000, right? So 32,000 of accumulated depreciation of the sold equipment is removed. And so, but depreciation in the accumulated depreciation increased. This negative number because it's a counter asset. Just look at the number, the increase. So we removed 32,000. We must have depreciated 62,000 to end up with a net increase of 30,000, right? So depreciation expense of the year is 62,000. Okay, so we can use, you can use T account to do the same thing, but I think it's pretty obvious. Okay. Yeah, so we're out of time, so we'll just leave it here. We'll continue when we come back on Thursday. Okay. All right. See you later.